Right now, we are looking at Circle Internet Group, ticker CRCL, trading live at 68.56, down 1.16 on the session, which represents a decline of approximately 1.67% intraday. If you are watching the tape right now, you are seeing a stock that is fighting tooth and nail to hold the $68 support level, a psychological floor that, if broken, could open the floodgates to significantly lower valuations. But the raw number on the screen tells you absolutely nothing about the war being fought behind the scenes between retail optimism and institutional caution. When you look at a company like Circle, the expectation from the general public, and perhaps even from your own intuition, is that you are looking at a crypto play. The assumption is that Circle moves in tandem with Bitcoin, that it surges when the crypto markets heat up, and that it bleeds when the digital asset class faces a winter. That is the expectation. The reality, however, is far more complex and, frankly, more dangerous for the uninformed investor. The reality is that Circle is not trading like a crypto asset today. It is trading like a proxy for the Federal Reserve's interest rate policy, compounded by a very specific, very concerning internal signal: insider selling. While you might be tempted to load up on shares through your Robinhood app or your SoFi Invest account because you see a red day as a discount, the institutional money moving through dark pools at Interactive Brokers and Fidelity is telling a different story. They aren't selling because they hate crypto. They are selling because the mathematics of Circle's profitability are fundamentally shifting under our feet. To understand why CRCL is down 1.67% today to 68.56, we have to strip away the blockchain branding and look at the engine. Circle issues USDC. When you buy USDC, you give them dollars. They take those dollars and park them in short-term U.S. Treasuries and cash equivalents. They keep the interest. You get the stability. It is a brilliant business model, essentially a bank with 0 branches, 0 tellers, and a fraction of the regulatory overhead of a traditional J.P. Morgan or Bank of America. However, this model has an Achilles heel. It is addicted to high interest rates. The market is selling CRCL today, not because Bitcoin is crashing, but because the bond market is pricing in yield compression. Every basis point that falls off the 10-year or the 2-year Treasury yield is a direct hit to Circle's bottom line. The smart money knows that if the Fed cuts rates aggressively to save the economy, Circle's free money machine, the interest income on its reserves, starts to sputter. Let's look closely at the intraday action. The stock opened near 69.70, tried to push higher in the first 15 minutes of trading, and was immediately met with a wall of sell orders. This wasn't a panic dump, it was a structured distribution. We saw heavy volume on the 15-minute candles right around 10:30 a.m., which usually suggests that larger funds are trimming positions into strength. If you are sitting at home managing your own money, perhaps using Schwab Intelligent Portfolios or just manually picking stocks in your individual brokerage account, you need to recognize that this price action is characteristic of a risk-off rotation. Investors are rotating out of riskier fintech names that enjoyed a massive run-up post-IPO and moving into defensive sectors. Remember, Circle went public around $31 a share. Even at 68.56, it is sitting on massive gains for the early investors. The pressure we are seeing today is partly profit-taking from those who got in early and are now seeing the writing on the wall regarding interest rate yields. There is another layer to this $1.16 drop that we cannot ignore. We have seen reports and filings indicating insider selling over the last few weeks. When the people running the company, the executives and directors who know the books better than anyone, are selling shares, it forces us to pause. It doesn't mean the company is doomed, but it breaks the momentum. It creates a psychological ceiling. Retail investors on Robinhood stock trading forums might be cheering for a moon mission, but when the CEO or huge early backers are lightening their load, it creates a supply overhang that is very difficult for mere retail buying power to absorb. You can see this on the chart today. Every time CRCL tries to bounce back to $69, it gets swatted down. That is supply. That is paper hitting the market. Now, let's challenge the narrative that this is just another tech stock. Most people put Circle in the same basket as Tesla stock, Apple stock, or Nvidia stock. High growth, tech forward, future of humanity type plays. But Circle is actually a financial utility. It is closer to a payment processor like Visa or a custodian like State Street than it is to a software company. The market is struggling to value it correctly. Is it a tech growth stock that deserves a 50x multiple, or is it a bank that should trade at a 12x multiple? The volatility we are seeing, this drop around the $68 to $75 range over the last few weeks, is the market trying to decide what Circle actually is. If it's a bank, it's expensive. If it's a tech platform, it might be cheap. Speaking of platforms, the accessibility of this stock has been a major driver of its volatility. In the past, you needed a specialized broker to touch anything related to crypto companies. Now you can buy CRCL alongside your Fidelity mutual funds or inside your Fidelity IRAs. The integration of crypto-adjacent stocks into the mainstream Fidelity trading platform and SoFi active investing dashboards has democratized access, but it has also introduced hot money. Hot money is capital that isn't loyal. It flows in when the chart is green and flees the second the chart turns red. The 1.67% drop we are seeing today is likely exacerbated by this hot money flushing out. Traders who bought at $72 hoping for a quick breakout are hitting their stop losses at $68.50. This creates a cascading effect, pushing the price down further than the fundamentals perhaps justify. Now let's shift gears to the macro environment, because you cannot trade CRCL in a vacuum. The Federal Reserve's policy is the single biggest input for this stock's valuation model. During the high interest rate era, Circle was printing money. They held billions in reserves, earning 5% risk-free, and paid out zero interest to USDC holders. It was arguably one of the greatest arbitrage trades in financial history. But as we stare down the barrel of potential rate cuts, that spread compresses. If the Fed cuts rates to 3% or 2% over the next 18 months, Circle's revenue gets a haircut. The stock market is a forward-looking mechanism. It doesn't care what Circle earned last quarter, it cares what Circle will earn in 2026. The weakness at 68.56 is the market pricing in that future revenue contraction. However, there is a contrarian take here, the reality that exceeds the expectation. While the revenue from interest might drop, the utility of stablecoins is exploding. We are seeing more transaction volume on blockchains than ever before. We are seeing the tokenization of real-world assets. If Circle can transition from being just an interest rate arbitrage shop to a true global payments network, where they make money on transaction velocity and value-added services, then the interest rate environment matters less. This is the bull case. This is why you might hold this stock in your SoFi robo-advisor portfolio, despite the volatility. You are betting that USDC becomes the piping of the future internet, the HTTP of money. If that happens, $68 is a steal. But that is a big if. We also need to talk about the institutional landscape. When we look at flow data from major desks like Interactive Brokers, we see that hedge funds are playing Circle differently than retail. Retail is buying the equity outright. Hedge funds are likely selling calls against their positions or using complex option strategies to harvest volatility. The implied volatility on CRCL is high, which makes options expensive. This suggests that the market expects big moves, either a breakout back to $80 or a breakdown to $50. The stability of the stablecoin does not translate to the stability of the stock. Furthermore, the regulatory picture is a double-edged sword. On one hand, regulation validates Circle. They have positioned themselves as the white hat stablecoin, the one that follows the rules, unlike some of their offshore competitors. They want the government to pass stablecoin legislation, but on the other hand, regulation brings costs. Compliance is expensive, lawsuits are expensive. If the US government decides to launch a central bank digital currency, does that kill USDC? Or does it make USDC the private sector interface for the digital dollar? These are the questions keeping the stock pinned at $68.56. The uncertainty is palpable. For those of you using Robinhood Crypto to trade the actual tokens, you understand the mechanics of 24/7 markets, but CRCL trades on the NYSE. It has opening bells and closing bells. This disconnect creates gaps. If a major crypto event happens on a Sunday, CRCL will gap up or gap down massively on Monday morning. This gap risk is something you don't get with Apple stock or Tesla stock to the same degree because their businesses aren't tied to a 24/7 volatile asset class in the same direct way. You need to be size appropriate in your portfolio. If you are using Fidelity wealth management principles, you wouldn't put 50% of your net worth into a stock with this kind of binary